So the topic today, the What's Promised, was a presentation about the startup and administration of a business through a corporation, with a focus on the efficient use of professional service providers, the management of the corporation through a board of directors, and the relationships among shareholders of the corporation. So I thought one of the best ways to start is to actually look up here at the front screen. This is the standard splash that you see when you come to these presentations. And the main sponsor is CIBC. Now, CIBC is a bank, but it really is a corporation. And thank you to CIBC. Thank you to all the sponsors. If we look at additional support below, there are a couple of other law firms, Ogilvy, Renault, and Davies, eminent competitors and great firms. You'll notice that they have LLP at the end of them, and they have proper names at the beginning. They're not corporations. My firm, Blake Cassels, is not a corporation. They're partnerships. And I'm not going to dwell a lot on partnerships, but I will explain to you a couple of the key differences between partnerships and why the venture capitalists in your life that you may meet are keenly interested in partnerships as opposed to corporations. And then there's the J.P. Bickle Foundation, which would be a kind of corporation, but a charitable corporation with major limitations on the kinds of business it can carry on and the kinds of assets that it can own. Basically, it needs to dedicate its resources to things like this, education, other things that help the general public. And then there's St. Joseph's Communication, which I imagine is also a corporation. So why are corporations so prominent in the life of our economy and so important to entrepreneurs? Well, one of the hallmarks of a corporation is that it is a separate legal person. When you found a corporation, and it's quite easy to do in terms of setting up a very basic company, you're actually creating another entity. In the eyes of the law, a corporation is as much a person as you or I are. And that really, when you think about it, is an incredible achievement. And corporations have been around for a few hundred years, but really they've only risen to prominence in the last 150 years. They're truly a creation of the Industrial Revolution. One of the world's longest standing corporations is well known to Canadians, Hudson Bay Company. The company of adventurers who trade out of Hudson Bay is the formal name of the company. And it was incorporated back in the 1630s, I believe, 16-something. And it's existed continuously since that time. And that's another hallmark that's so important to business people of corporations. I will die one day. A corporation that I form theoretically can last forever, provided that it doesn't go bankrupt or have another kind of life-changing event. Companies are immortal. And that's valuable for people who want to have changes of ownership from one generation of a family to the next, from one business partner to the next business partner. And again, when you step back and think about it in theory, quite a remarkable thing that you can create something that in the eyes of the law is immortal and that truly can last forever, barring unforeseen circumstances. So why is this thing so important? What's the one attribute about it other than this immortality I've talked about? Excuse me. It's this feature called limited liability. When you carry on business, when you incur a debt, when you have an obligation visited upon you as an individual, you know, the people to whom you owe that obligation can go after your assets, your home, your salary, in most cases your pension plan. You really don't have any protection against the failure of your idea, of your business. What a corporation that is a limited corporation, which is 99% of companies that are created in Canada, offers to you as an entrepreneur is this shield. Basically, a company is liable for its own debts. The owners of the company, the shareholders, are not liable for the obligations of the corporation. They're only exposed to the extent of their share ownership. the most that they can lose is the extent of their investment, the value of their shares. And this also is incredibly valuable because what it means is that you can get people who can buy into your company, buy into your idea, and expose themselves only to your corporation. They don't need to worry about your personal history, the other liabilities that you're incurring. What they're buying into is basically the idea, assets, and liabilities of that single entity, the corporation. Now it's this, this is a powerful idea, and as we'll see in the next few minutes as we go through the various stakeholders in a company, it's the one idea that overrides everything else and causes some of the problems or difficulties that you'll encounter when you're running a business through a corporate model. And there really is a triad of interests that are involved in a company. It's the shareholders, the directors, the board of directors, and third, the officers of the company. So what role is it that each of these stakeholders has to play in the life of your corporation? Let's start with the shareholders. Well, the first and most important thing they do in the life of the company is they elect the directors. So the idea of a corporation is that shareholders generally, although it can change from company to company and situation to situation, but shareholders generally are pretty passive owners. They own the assets and liabilities of the company, or they are entitled to the fruits of the company, but they don't have a lot of rights to run the company. Their right to run the company is really wrapped up in a single right, which is to elect the board. Now, they do another important thing too. They are the ones who appoint the auditors of the business. So the financial gatekeepers or guardians, the shareholders select those. What other rights do they have? Well, to the extent that dividends or the fruits of the business are paid out, they're entitled to get those. And they're entitled, if the business is wound up, to get the proceeds of the sale. They're also then given some rights to make their voice known, to have a prior approval for certain major things that are done in the life of the company. So, for example, if the board wants to sell all or substantially all of the assets of the business, the shareholders have to approve that. If the company wants to change its name, the shareholders need to approve that. And if the company wants to change the terms of the share conditions or other things in the articles like how many directors the company should have or where the registered office of the company is, again, that is reserved to the shareholders. But that's about it. So great to be a shareholder. You get the fruits of the company. You can appoint the financial guardians, and you have certain approval rights over major changes. But you have, other than the right to appoint the board, essentially no right to participate in the management of the company. So the management of the company is in the hands of the board of directors. So what are the responsibilities of the board? Their main obligation is called the duty to manage. They are charged by the corporation statutes with the duty to manage or supervise the management of the business and affairs of the corporation. So not the shareholders, but the directors. And in doing so, they have another broad duty imposed upon them called the fiduciary duty, or duty of care. And fiduciary comes from a Latin word meaning trust. So, trust is reposed in them to run the business for the benefit of shareholders. And specifically, every director of a corporation has to act honestly and in good faith with a view to the best interests of the corporation. And so that's called the duty of good faith. And then the second duty is one called the duty of care, which is to exercise the care diligence, and skill that a reasonably prudent person would exercise in comparable circumstances. So the locus of control of management is in these directors. Now, a director doesn't have to own a single share. You could form a company, and you could make your neighbor a director if your neighbor agreed. But as the shareholder, you're the one with all the economic rights, and the director really only has responsibilities. So what's wrong with that? There's a disconnect here, right? So the person who has all the ownership rights can appoint the people who run the business, but the people who run the business don't have, unless they're given something by way of a salary, for example, or a fee to serve as a director, they have no economic interest or stake or benefit from the corporation. And as we'll see, directors have lots of liabilities. So not only is there not a lot of upside, there is a lot of downside. What are some of those liabilities? Well, if they make a mistake in paying out a dividend, which is for the benefit of the shareholders, right? So if they make a mistake in conferring a benefit on the shareholders by redeeming their shares or paying a dividend or giving an indemnity, which is a fancy word for, promising to keep somebody whole if they incur an obligation, then it's the directors who are themselves liable to repay the company for their mistakes. Directors are also liable in certain circumstances for things like unpaid wages of employees, unpaid income tax remittances, failure to make withholding tax payments, unpaid sales taxes, environmental liabilities, and criminal offenses. So, there, as you can see from this list, and unfortunately it's only a partial list, there are a lot of downsides to being a director. Sure, it can be exciting and fun, and you can help manage and create wealth and advance ideas, but there's a breakdown in the risk-reward relationship going on in the heart of the company. So what do directors do to protect themselves? How can you convince your neighbor to be on your board? To convince a business advisor, somebody that you trust to help you in your venture? Well, there's a due diligence defense in the statute which says that if directors do the things that they normally would be expected to do, if there's something extraordinarily being done in the background like fraud, they're not liable for that. They can also rely on expert reports. So if you get an auditor or a business valuator to give you a report as a board, you can rely on it unless on its face it's absurd to do that. And you can buy D&O insurance. But those are only partial protections. So let's talk about, for a minute, about officers, and then I'm going to try and weave together the complete picture of this triad of interests who really make up the life of a corporation. So, the board typically for a company meets quarterly. In some rare circumstances, like really hands-on owners of a startup company, you might have a board meeting every month. I guess the absolute maximum I've seen is every 2 weeks, but that was really only for a pretty short stretch to get the company through some particularly difficult times. So the board has this responsibility that I went into placed upon it, but it's not there every day. So who runs the business from day to day? Well, the board is authorized by the corporate statutes to appoint officers, such as the CEO, the CFO, vice presidents, and others, to run the business in the absence of the board. The officers, though, report formally and are responsible to the board for their actions. And this varies from company to company. I mean, usually it's at least the CEO has a direct reporting relationship to the board, but sometimes, particularly in smaller businesses, the CFO will report directly to the board, or the CIO, Chief Investment Officer, in some kinds of businesses. But whatever structure you come up with, the basic model is that the officers are empowered by the board to run the business and report to them and to get approval for big events in the life of the company. But when it comes to everyday, ordinary things, do we buy a Xerox copier? Do we, things that are not huge, out of the ordinary things in the life of the company, that's really left in the hands completely of the officers as management. Now, an officer actually does have that same duty of care that I went through earlier for directors. So they have to act honestly in the best interests of the corporation, and they have to exercise the diligence and care that a reasonably prudent person in similar circumstances would exercise. So they've got a high burden on them too, but in practice they have, beyond that, very few statutory liabilities. And again, there's a risk-reward mismatch, because particularly in bigger companies, you hear about the pay packages of some CEOs that can be astronomical. Boards of directors typically get very little in the grand scheme of things for doing their job. And yet that's the position that I went through that litany of risks, the downside, the liability exposure that they have. So in the life of the entrepreneur's company, how do you address these imbalances? Well, one of the geniuses of the corporation is, and there was actually a case at the beginning when corporations were first put together that was a milestone case, because there, the company had one shareholder, and that shareholder was also a director, and that director was also the CEO. So it was really a one-person band. And the big case that went up to the highest court in the land at the time was, well, that's unfair. You can't have a person who has the protection of limited liability as a shareholder, and yet who is a director and the CEO all at the same time. And the court said, no. People can wear different hats. You can put on your hat and you have your responsibilities as a shareholder, and then you can put on your other hat, you're the director, and you can put on your hat as an officer. So the one-person company works. That's terrific news for entrepreneurs, because every startup I've ever seen is either a one or a two or a three-person band, and the shareholders are the directors, are the officers. So that's one of the ways of avoiding this mismatch, because if you're all three, then you've got the upside of shareholders and you can help run the business as the officers, and then you have your board meetings. So you can do that, and it's workable. But how do you access those really smart people that you know who are in your space and you want to get their advice? One of the first reactions that I find entrepreneurs often have is, well, I want to get that person on my board. You may find, though, when you go to ask that person to be on your board, they're a bit standoffish. Maybe they heard this talk before. Because really for a person who is an expert in a space, has her own life, wealth, business, why should I be exposed, this person is saying to him or herself, to serving as a director of a corporation where I may be visited with all kinds of liabilities that I can't really control? So really the answer then is to say, not so much your first reaction, which is be on my board, but rather be on my advisory panel. You won't be a director. You won't have any exposure to that litany of things I had up on the screen there. All I want is your advice. So you're not a director, you're an advisor. Please come and just give me your wisdom. And you can get a bunch of people together to do that. And that really is more and more, I think, becoming the model of a lot of venture capital startups. What you do is you access talent through advisory panels. And the people who are the directors of your business are your co-shareholders, your co-officers. That's one way around this risk-reward mismatch. Now, I said at the beginning I'd talk a little bit about a different kind of entity, namely a partnership. And I said that if you know venture capitalists, you will eventually come to learn that they love partnerships. And you'll have to learn a bit about those. So I'm just going to take a couple of minutes to explain why venture capitalists love partnerships. And it has to do completely with tax. Because a corporation is a separate person in the eyes of the law in Canada, a corporation is a taxpayer. A corporation has to file an income tax return. A corporation is liable to pay tax at the corporate tax rate. You and I as individuals are taxpayers. We have some deductions and all the rest of it, but we're liable to pay tax on our income and our capital gains, whether our income is employment income or business income or dividend income. So as I pointed out at the beginning, those law firms were partnerships. Why is a partnership different from a corporation? Well, a partnership is not, in the eyes of the law in Canada, a separate legal entity. So a partnership is not a taxpayer. Only the people who are the partners of the partnership are taxpayers. And why that's important is that startups have big, huge, as we all know too well, startup costs. Before you start making money, you're incurring expense. So the early life of the entrepreneur's company is full of expenses. And those expenses are expenses of the corporation. So the only way you can utilize those expenses if you have income is for the corporation to have income. And you might not want to wait to be able to utilize these losses. And some of them actually over time do expire if your company isn't successful soon enough. So when a venture capitalist comes along, the venture capitalist is saying, we'll do a partnership. So I'll invest in your business, but it has to be a partnership. And why? Because all of the startup costs, because the partnership is not a separate taxpayer, flow through to the corporation that is the venture capital corporation. And so the losses don't get trapped in the startup company. They're able to be utilized by the venture capitalist. Now, I don't have time to go into all the attributes of a partnership, but partnerships are sort of a different breed of animal in the sense that if I had it, I could show you the Corporations Act in Ontario, for example, is about that thick, and the Partnership Act is less than that. So basically, the corporation is developed by statute so that there are lots of rules that provide for virtually every kind of situation you can think of. Whereas a partnership is very simple. And basically, the Act says, two or more people can carry on business in partnership according to their agreement. So what that means is that people have to agree. So the partnership agreement, I've seen some that are literally this big. They're huge. Now you can have something as simple as 2 pages, but venture capitalists typically aren't that simple. They want to provide for all kinds of rights, that they have to monitor the business and approve business plans and approve significant hurdle achievements. So, the corporation is a wildly flexible, a wonderfully amazing vehicle, but it doesn't serve all interests all the time. And partnerships will be in your future, as I say, if you have venture capitalists around. So, if I can just for a moment recap where we started and where we're now. I've talked about how a corporation is a separate legal person with really the rights of a natural person, but different from natural people, they can go on forever. And the way that you transfer the ownership rights is by selling the shares. You can create new shares, which has the effect of diluting the other shareholders down. or people who are the owners can transfer their shares, can sell them to other parties. And one of the reasons that's really quite nice is that, when I pass away, the Canadian tax law says that all of my assets are deemed to have been sold on the day that I died. And my estate has to pay tax on that. If I'm an owner of shares in a corporation, if I die, the corporation continues on. There's no tax event for the corporation, basically. My estate has to pay tax on the value of my shares, but the corporation can continue on. So there's a continuity of life that the corporation provides that is not possible for individuals. So I talked about how there are really three main legs, a triad of interests in the company. There's the shareholders, who own the economic rights and are entitled to dividends and other payments. But they don't really have a lot in the way of management rights. They can elect the board, appoint the auditors, and approve certain major changes in the life of the company. And then there's the board of directors, which is really the locus of management and the place where the legislatures have placed the main liabilities of corporate life. And then there are the officers, who are the day-to-day people to run the business. And they have the same duty of care, but beyond that, very few statutory liabilities. And then I talked about an advisory panel. And really these people should have things like the available expertise for the corporation. There's no liability for them. They can bring a diversity of skills and views to your business. And one of the things that I recommend to people about the makeup of your advisory panel is, don't select people in your own image. Too often, we like to have people who agree with our ideas. So we pick, and our friends are typically people who are like us. But in my experience, the people who can bring the greatest vision and the greatest difference of view are people who are very much unlike you. So say you're an engineer and you're in a biotech startup. What about an environmental person on your advisory panel? Just to give you the perspective of somebody who may not be in love with genetic engineered crops so much as you are. You don't have to pick people who are your own age. If you're a young person, and somebody in his or her 50s who has had lifelong experience in a business, try that person out. Get that input of ideas. And who knows, the people that you pick as advisors may really come to like your business and say, well, I'm willing to be an angel investor. I wouldn't go over after advisory panelists on that basis, but it's something that over time can evolve, and I've seen it work. Well, let me turn to what is sort of the main focus, I think, of this presentation, which I've left to last. And that is, I've explained a bunch of theoretical stuff about how corporations work. Let's talk now about how you can make your startup actually work. What are the resources that you can tap, and how should you tap them to maximize the chances of success of your business? Now, these are all people who cost. So really what I'm trying to give you is hints about how to maximize the value that you receive from these professionals in your business. A cost, yes, but hopefully a cost that actually adds value rather than at the end of the day is a net cost. So let's talk first about accountants. So, if you're a small startup, you got 1, 2, 3 friends or family members, you don't have to have audited accounts. The corporation statutes in Canada allow you as the shareholders to waive the requirement for an auditor. So that thing I had up at the beginning about how the shareholders appoint accountants or auditors, you don't need the full audit level. You can say among the shareholders, and all the shareholders have to agree, so it has to be unanimous. We're not going to have an auditor. We don't want to incur that expense in the startup of our company. We'll wait until down the road. And if you get a venture capitalist, you'll have an auditor right away. So that usually is the first inflection point for startups about when they meet the auditor as opposed to the accountant. Now, every business does need an accountant because you've got to keep accounts, if only to be able to pay your income tax. You have to file, as I mentioned, a corporation is a taxpayer. A taxpayer has to file a tax return. And even the most basic tax return for a corporation really does require you essentially to have a balance sheet and financial statements. But you can find, if you look hard, people who, there's one lady I know who's helped a lot of startups, and she worked with Ernst & Young for many, many years and retired when she was 55 or so. And she just liked accounting. And what she ended up doing was helping a lot of startups doing very basic accounting for very little. So if you can find someone who is competent, can charge you a fixed fee that you negotiate up front, and if you give them enough time, and this is actually something that I would emphasize for all professionals. I once knew a lawyer from Texas, and he had a sign in his office, and it had 3 words on it: fast, cheap, and right. And he says, you can have any 2. You know, if it's fast and right, it's not going to be cheap. If it's fast and cheap, it's not going to be right. I mean, what he's saying is, you know, when you press a professional to do something on a turnaround basis, where they don't have time to plan and allocate resources of, say, more junior people or people in other offices of their firm, then they're going to charge you more. So if you plan for taxes, don't wait, if you're a company, to get your accountant your stuff for the tax return until April 20th, right? Do it in January. If you have a year end of December, you've got all the stuff in January. I guarantee you that if you go to an accountant, not one of the big accounting firms, but a smaller accounting firm or an individual accountant, say, look, I want you to do my tax return, and I guarantee that you'll have all the information that you need to do it by January 31, how much you're going to charge me, versus, you know, you arrive with a shoebox of cluttered receipts on the 15th of April. You're going to get at least half off. So when dealing with professionals, including in particular accountants, plan and don't put them under time pressure. And you'll be better off, and they'll be better off, because they'll like serving you better. So that's accountants. The next horrible in this parade of horrible is lawyers. Well, lawyers are very much the same, I think, as accountants. You know, the larger firms are, quite frankly, probably not going to be the appropriate advisors for the startup companies. Although in some cases there are exceptions always. If you have a friend that you know, or a family member who can do something at less than full rates, great. But really what you're looking for in a lawyer for your high-tech startup is someone who probably knows your business a little bit. Someone who's got a background in pharma or in computer software or in whatever it is that you're chasing after in your business. And if you search again, you can find those who are less expensive. And one woman used to work with me, and she set up her own business advising exclusively high-tech clients, and she charges them a relatively small rate for ordinary advice, a fixed fee per month, and her clients love her. So I would look carefully for the right lawyer and not simply say, well, lawyers are too expensive, I'm just going to do without lawyers in the startup phase. Because there's nothing like an ounce of prevention for a pound of cure. I don't know the metric equivalent of that. But, you know, I've seen so many cases where people don't keep the proper records when they have their startup, or they don't apply for that really important patent, or they don't get a copyright for something, they don't trademark the wonderful name that they've developed. And really those are critical steps in the life of a company. And I can tell you from the perspective of seeing how venture capitalists react to companies that haven't taken those key steps. Often they get in the proposal, they ask that question, you say, no, it's in the garbage. So, buy legal services wisely to protect the key elements of your business early on. If you have other shareholders along with you, get a shareholders agreement. It doesn't have to be long and complex, but every startup, Jobs and Wozniak, when they started Apple, they didn't have a shareholders agreement, and they had some terrible fights. They got over it, thank goodness. But I'm sure Gates and whoever his partner had didn't have a shareholders agreement either, although Gates' dad was a lawyer, maybe he did. But I've seen and tried to help shareholders who are in situations where they haven't had an agreement between them as to agreeing on how to elect the board, having what's called a shotgun clause in it, so that you start your business with every hope that the idea does well, and say it does do really, really, really well. You need the consent in a private company of the other shareholders to sell your shares. Well, if you don't get that consent up front, you can get stuck. I mean, the people in the pizza business started up small, became huge. They had a shareholders agreement that didn't work, and they were in litigation for 8 years, and it went up to the Ontario Court of Appeal twice. My friend did all their litigation. So taking some steps at the beginning of a relationship and through the life of the company to protect the fundamental assets and attributes of a company by judiciously getting legal assistance is, in my view, really worthwhile. And you can tell that I'm not selling lawyers big time in the sense that the larger firms are probably too expensive for you, so I'm too expensive for you. But there are, I'm sure, lots of people out there, if you search them out, who will be able to meet your needs on a relatively economic basis. This third category, investment bankers, you're likely not going to meet them for quite a while in your startup. But once you've met venture capitalists, you're much more likely, if that is a successful relationship, to meet investment bankers. Because venture capitalists want to do one thing. They want an exit in 3 years maximum. And their exit will be typically a sale of the business. And except in rocky markets like today, the main exit mechanism, one of the two main exit mechanisms for venture capitalists, is doing an IPO. And really you need investment bankers to do that. Investment bankers will, oddly enough too, particularly in this market where they're not so busy, help in trying to get funding. They're unlikely to find pure equity for you. In other words, they're unlikely for startups with not a lot of track record to be able to find people who will buy common shares. But they may well find mezzanine, sort of high yield debt providers who will provide a debt at really very high rates. But if you need it, and that's the only thing you can get, very worthwhile. The next category I'd like to talk about is advertising agencies. And that may sound a little bit odd to think of early in the life of a startup. But actually, you can get incredible insight, I find, from the creative minds at advertising agencies. And it may be something as simple as, you've got to have a website. I've heard people in the ad business say, unless you have a website, you don't exist in today's market. And an $800 website with 5 or 6 landing pages, your product, logo, contact information, what you do, can give a credibility to your business that few other expenditures of $800 or $1,000 could give. Getting some advice from an advertising agency about your name. And there's Frog Energy versus Diversified Energy Incorporated. There are certain names that really ring true and people remember. And when you're in a startup, kudu. You want a name that's going to ring true with people. Apple. And advertising people are good at coming up with that kind of name. And, coming across professionally by having a really good logo with stationery. Doesn't cost a lot of money, but can make you look like a real business even before you really are one. And last but not least, Mars. I'm sure you know at least something about this terrific place. It has all kinds of resources available through the Government of Ontario, grants and other things. These Entrepreneurship 101 presentations sponsored by CIBC and others. There truly is a wonderful repository of resources here that Tony Redpath and others can help you access. And from some of the things I've seen the Mars Incubator and other companies do, this is a wonderful place. We truly are blessed to have in Toronto this resource. So that brings me to the end of my presentation. I'd like to entertain questions from the floor if anybody has them. Go ahead. Sure, the question is, the question is, when directors have meetings, they can be in a room together, or can they be remote? And the answer is yes. You can have a meeting even just by teleconference. The only legal requirement is that all directors can hear everything that's said all the time. And so the normal teleconference feature does it well. And in fact, the companies that I'm involved in, 80% of them do most of their meetings where almost all the directors are participating by telephone. So the question is, how do you compensate advisors? And really the reference is to, I think, the advisory panel and getting advice from experts in the area. The whole thing about an advisory panel is that generally it's not a consulting kind of arrangement whereby the people who are on the panel expect to be paid an hourly fee or a project fee. So the whole notion of an advisory board is that what you're trying to do is attract somebody who, mostly out of the goodness of his or her heart, is willing to provide you with some advice because they were young once too, and identify with the molecule or the software idea or the engineering concept that you have. And hopefully we'll do it for the cost of dinner every now and then. So the question is, what, when you're looking at your business plan for a year, should you put into your budget for legal fees? Well, I mentioned that I know this woman, her name is Susie Dingwall Williams, and she actually offers, we're not related or in business together, I just know her from, she used to work with me in my firm. And I know there are other people like her. She offers a service basically for a monthly fee, advice at a flat cost on basic, ordinary, everyday things. So to the extent you have special things that arise, like you need to apply for a patent, that's obviously a whole different cost thing. But I think that she offers something that's in the range of $3,000 or $4,000 a year for monthly advice by telephone on day-to-day things. Too much. Yeah, for $50,000, you get a fair bit done, actually. Yes. Anyone else? I saw a hand. This is a terrific question. The question is, in the US, you see entities that end with LLC, and that means limited liability company. And that's a development in the last 15 years in the US that we've not had in Canada, I'm afraid to say. But it's good to know about them because you can understand what they are when you deal with them, because you may have to contract with them in a cross-border situation, US startup or you or a supplier. Basically, an LLC is an entity in the US that gives the protection of a company, i.e. limited liability to shareholders, but that gives you that thing in Canada I said that companies don't have and that partnerships do, and that's the ability to flow through losses to the owners. So they're not called shareholders, they're called owners. I mean, they have boards of directors and they have shareholders. But the beauty of them is that for the startup, it allows the owners to be able to write off the losses in proportion to their ownership in the LLC. And they've become wildly popular.
Sort of like partnership.
Yes, not quite, but that's it. The statement was, so sort of like a partnership with limited liability, that captures most of it. And unfortunately, to date, there's nothing in Canada. I wrote a paper about 8 years ago to suggest that we have them, particularly for startup companies. It was published by the Queen's University Law Journal, and had all kinds of government officials write me and say what a great idea it was, but nothing's ever happened. Yes? Is there a legal requirement to have a board of directors? Yes, every corporation must have at least one director. So it can, as I say, be the one-man band, the one-woman band. It can be the person who's the shareholder and the CEO. But yes, and in fact, if you don't have a director because the one director has resigned, you basically can't carry on the business. So the question is there a requirement to keep documents about your board of director meetings? Basically, lots of startup companies have one meeting of the board a year and one meeting of the shareholders a year. And all that happens at that meeting is that the shareholders elect the directors for a further year, and the directors basically approve the financial statements. So it's not a huge requirement. It's basically 8 pages. And that's something you can find typically online. So yeah, at the beginning, it's a very minimal, simple requirement. Once a year, you need a board meeting. Once a year at the same time, you have a shareholder meeting. And if it's a one-person thing, I mean, you just basically have a written resolution. You don't have to have a meeting. You can't really have a meeting with yourself. At the back there, yes. So the question is, would I advise against a person starting up his or her own corporation versus getting legal advice? You need some legal advice, but there are a couple of really good incorporation manuals out there that you can buy at Indigo. And if all you're doing is setting up a very simple company, that's completely adequate. I mean, where it gets complicated is, as I mentioned, if you've got other shareholders, you've got family members or friends, life will be better for you in the long run if, in addition to the basics of the company formation, you also have a shareholder agreement. And that's a bit more complicated. And so that I would suggest you get legal advice on. But the actual setting up these incorporation manuals, pretty straightforward. The question, it's a good one. They're all good. The question is, can you anticipate dispute resolution, or do you have to wait till it occurs? Well, that's actually why I recommend you have a shareholder agreement, because what you do with the shareholder agreement is typically provide for certain rights in connection with being a director, who votes for which director, how big is the board, what happens if there is a dispute and one party wants to sell. There's a very simple mechanism in the standard shareholder agreement called a shotgun buy sell, which means is if, take two shareholders, they each own 50% of the company, and you need the other shareholder's consent to sell your shares. And the other shareholder says, no, this is a deadlock. What do? If you have a shotgun buy sell in your unanimous shareholder agreement with the other shareholder, that gives you the right to say, okay, I say the shares are worth $150 a piece. And either I get to buy your shares at that amount, or you can buy my shares at that amount. And you got 30 days to decide. And if you don't tell me within 30 days that you're buying mine, then on the 31st day, I commit to buy yours for $150 a share. So it's anticipating disputes in that way and providing for exit mechanisms that is the typical thing you see of real importance in the shareholder agreement. Well, I think that brings us to the end of the presentation.